Hello, welcome to the final module of the course taxation, and we will look into international taxation. We'll be introduced into international taxation, and we will look at concepts and needs for international taxation. We look at double taxation and relief mechanism. We also look at overview of transfer pricing principle, international tax treaty and agreement, and we will look at the emerging global trends in tax coordination, and this will be done briefly, very briefly. We have the full notes available, and introduction to international taxation provides a comprehensive exploration of the principle, challenges, and evolving practices in the taxation of cross-border transactions and multinational operations. And in an increasingly globalized economy, businesses and individuals frequently engage in economic activities that span multiple jurisdiction. They span multiple jurisdiction, creating complex tax obligation and raising the potential for double taxation. So international taxation therefore seeks to provide a structured framework to allocate taxing rights fairly between countries, prevent tax avoidance, and also ensure compliance while facilitating global trade and investment. What is international trade then? It's actually the framework of rules for taxing cross-border economic activity. It's the framework of rules that is put in place to ensure taxing of cross-border economic activities. And the core question that is being answered, asked is which country has the right to tax income when economic activities span multiple jurisdictions. And from there, we look at we see the key players. And the first is the source country, and the second is the residence country. Talking about the source country, it's actually where the income is generated. And looking at the residence country, it's actually where the taxpayer is based, where the taxpayer is based. And the guiding principle for this is income should be taxed where economic value is created. Income should be taxed where economic value is created. And the goal is actually to bring about a balanced taxing right to prevent double taxation and also combat tax avoidance. Looking at a major aspect of international trade, double taxation. What is double taxation? It is when the same income is taxed by two or more countries. So if I am making a profit here and two or more countries are charging taxes on it, and that means that makes it a double taxation. And we have two types of double taxation. We have the juridical double taxation, which deals with same income, same taxpayer, two countries. And an example of this is the Nigerian residence tax in Nigeria and the US on US dividend. And the second is the economic double taxation, and this deals with same income, different taxpayers. An example of this is corporate profit tax, then dividend tax again. And the consequences of double taxation is actually that it discourages cross-border trade and investment due to excessive tax burden. And in looking at double taxation, we have reliefs from double taxation. And the first is, we'll be looking at tax treaties, and this is actually a bilateral agreement that allocates taxing rights, bilateral agreement that allocates taxing right, and it reduces withholding tax rates on dividend, interest, and royalty. And we have the relief methods via the treaty and the domestic law. And this method includes an exemption method, where residents countries are exempted from foreign income. It exempts foreign income. The resident country exempts foreign income. And we also have there's also the credit method, where residence country gives a credit for tax paid abroad. And lastly, we have the deduction method, which deals with foreign tax is treated as a deductible expenses, and this is least beneficial. We have another concept, which is the transfer pricing. And this is the price charged for transaction between related entities in different countries. And the example of this is a subsidiary selling goods to its parent company. And this is transfer pricing, the price charged for transaction between related entities in different countries. And the risk of this is artificially setting price high or low to shift profit to low tax jurisdiction. And the solution is actually the arm's length principle, which talks about transactions between related parties must be priced as if they were between independent parties, and also is supported by detailed documentation and comparability analysis. The role of international tax treaty, the purpose of this is to provide clarity, prevent double taxation, and also fight tax evasion. And this is based on the OECD Model Tax Convention. And the key provision is one that it allocates taxing rights between source and resident countries. It defines it defines reduced withholding tax rate. Also, it includes mutual agreement procedure for dispute resolution. And lastly, to enable exchange of information between tax authorities. We have the last aspect of the module, which talks about the emerging trends. And for this, we have the first, which is the BEPS project. And this is actually the base erosion and profit shifting project. And its strategies, these are strategies that exploit gaps in tax rules to shift profits to low or no tax location. And this is just coming up. These are emerging. And the global response to this is that the OECD or the G20 BEPS project has actually a 15 action plan to create a coordinated international tax system. And out of this 15, we have some prominent ones, which is like the Action 13, where country by country reporting. It deals with country by country reporting, and shows that the MNEs must report financial data for each country they operate in. And we also have the Action 8 to 10, which deals with strengthening transferred pricing rules for intangible and risk. We also have another trend, emerging trend, which is the rise of digital economic taxation. And the challenge is that the traditional tax rule rely on physical presence, and digital complaints can generate significant revenue in a country without a taxable presence. The interim solution is actually the digital service tax adopted unilaterally by some countries, and this is actually a solution, and we in the interim, and globally the solution is progressive, and the OECD brings about two pillars solution, and the first one is the relocation of taxing rights to market jurisdiction, and the second one is the introduction of the global minimum tax, which is 15% to end the race to the bottom. And why is international taxation, why international taxation matters? The first is for under government, it promotes or protect the national tax base, also ensure a fair share of revenue from multinational activities. It also promotes cross-border investment and cooperation. And for businesses, it provides predictability and reduces the risk of double taxation, and also it's essential for compliance, risk management, and strategic planning. In conclusion, international taxation is an essential framework for a globalized world, and double taxation is a major barrier relieved by treaty exemption and credit. We've also looked at transfer pricing rules, which are based on the arm's length principle, which prevents profit shifting. And we looked at the global trends, the BEPS, the digital taxing, and which are making the system more transparent and fair. And having an understanding of these rules is crucial for both national revenue mobilization and multinational business strategies. Thank you.